I've told you about the people who are standing in the way of your prosperity. Now I want to introduce you to one of the people protecting your money. Sheila Bair is the former chair of the FDIC, and she's been credited with saving the banks during the financial crisis. 25 banks failed in 2008 alone. There they are. They were taken over by the FDIC. The one you may remember most was Washington Mutual, the biggest bank failure in U.S. history. Now, I'll just tell you how this worked. While those banks failed, the FDIC worked behind the scenes to prevent panic and to keep your money safe. It would happen on Friday nights. The FDIC bank closure crews went into failing banks, took them over. By Saturday morning, the banks opened under a new name. Maybe it was Monday morning, but you never lost access to your money over the weekend. In fact, no one has ever lost a penny of FDIC-insured money. Sheila, good to see you. Thank you for being with us.
Nice to see you, Ali. Thank you.
Dodd-Frank handed power to regulators, to regulatory agencies, and you say they're not doing their jobs. Why?
Well, I think they're not doing their jobs in a way that's muscular enough. Only about a third of the Dodd-Frank rules have actually been finalized. And even when they are finalized or proposed, they're quite lengthy and complex. They're hard for the public to understand. And I think one of the reasons for that complexity is all the lobbyists come in and they want this exception or that and clarify that I can keep doing this, and they're accommodating that, and they shouldn't.
You're saying that we can adequately regulate outlandish risks. We don't want to regulate all risk because that's what creates a market, but we can do it without 600 pages of definition of one thing and 2,000 pages in an act.
Yes, I think we can. These financial institutions are too complex. That's one of the reasons why the management has such a hard time having adequate controls in place to catch misbehavior. We need to have higher capital requirements so that there are severe economic consequences when risks are taken that go awry.
The banks that were too big to fail before the financial crisis are even bigger now. In 2006, the top 5 banks held $6 trillion in assets, and that's 43% of America's total economic output as measured by GDP. Last year, they held $8.5 trillion in assets, or 56% of GDP. So they're bigger.
I think we're still working this around the edges instead of tackling the core problems. We need more competition. We need to rationalize these big bank structures.
There's sort of two things that are kind of interesting, and we can use regular language to explain them. One is this living will idea that a bank has to say, if something went wrong, how would we break ourselves up? And the other one is something that the FDIC had, which made you very effective, is you had what's called resolution authority.
Resolution authority is very important. This really is a bankruptcy-like process. It's the same claims priority. The shareholders, the unsecured creditors take losses just as they do in bankruptcy. And when these smaller banks would fail, there is no disruption in the core functions of the banks. That kind of mechanism can work very well with a large bank as well.
No, banks are important. We need them. They serve.
We do.
They serve a purpose. But there is an element of trust that's important. A recent Gallup poll shows that confidence in U.S. banks, consumer confidence in U.S. banks, was at 60% in 1979. It now stands at 21%. Do you think that's fair?
I think you do need to differentiate. The traditional banks, the ones that take deposits and make loans, they're not perfect, but for the most part, they're not involved in the scandals you're seeing now. This is bad activity that's going on the trading desk of these larger institutions. They apparently think that the laws don't apply to them, or some of them don't. Regulators are trying to work this too much on the edges, as opposed to just telling them you can't do it this way anymore. The LIBOR scandal is a prime example. Why did everybody knew it was subjective, it was ripe for abuse. Why wasn't it fixed when these issues came to the attention of some regulators in 2007 and 2008?
Sheila, you know so many of these bankers. You know the regulators. You know the lobbyists. Why has this become partisan, and why has it become so complicated?
Well, it shouldn't be partisan. Look, this is hurting everybody, Republicans and Democrats. It's hurting bank customers. It's hurting public confidence. It's hurting well-managed banks whose reputations are being tarnished. It's hurting the big banks themselves. It is hurting everyone. This should not be partisan. We need to get this fixed.
Sheila Bair, always a pleasure to talk to you. Thanks for the hard work you put in protecting people's money.